Hey everybody, Economic Ninja, and I just woke up out of bed. How you doing? Today, this is not your normal bro hawk. We're gonna dub this the bed hawk. That's right. I woke up this morning and got an amazing email from a buddy of mine, Nick Johnson. If you've never seen Nick Johnson, I'm gonna show you his YouTube channel, huge YouTube channel in a second. But we're gonna talk about commercial mortgage-backed securities and why I believe in my non-professional, non-financial advice kind of way, it is going to be the most glorious, epic collapse in real estate history, quite frankly. And with that being said, I am a licensed real estate agent, but I'm not practicing right now because I didn't want to sell someone something that's going to just go down after a while. A little bit of euphoria. All right. With that being said, let's jump right into it. Let's share the screen. First off, we're going to start with Nick's channel. This is Nick's channel, and I love his profile pic with the bow tie. It is totally awesome. So we're going to be talking about mortgage-backed securities, guys. We're going to jump right in here. First, we're going to start with the whistleblower case. Wall Street has engaged in widespread manipulation of mortgage funds. Now, this is dated back to May of 2020, and we know about then a lot of stuff was going crazy in the world and in the world's economies. But I don't want this to go I don't want people to miss what's going on behind the scenes. And we're going to get into what CMBS is and all that kind of stuff, but I want to go over this really quick. Securities that contain loans for properties like hotels and office buildings have inflated profits, the whistleblower claims. As the pandemic hammers the economy, that could increase the chances of another mortgage collapse. And it is absolutely going to, okay? And this is going to blow your mind. When I say this time it's worse, I could not be more serious, okay? Among the toxic contributors to the financial crisis of 2008, few caused as much havoc as mortgages with dodgy numbers and inflated values. Huge quantities of them were assembled into securities. The ninja needs some coffee. Where's can we get a Starbucks at least? I just joking. I can't stand Starbucks. You'd think that Wall Street would have some kind of coffee joint here. They were assembled into securities that crashed and burned, damaging homeowners and investors alike. Afterwards, reforms were promised. Now I'm going to stop right there because reforms were promised. It's called the Dodd-Frank Act, and that was able to hide a lot of stuff to make rich people richer and to be able to dodge a lot of stuff. And I want to make this very clear. What we're going to go over is very serious. All right. So right here, you see a story. CMBS delinquency rates continue to improve. Now, there's been a handful of these stories out in the news. And this was out 3 weeks ago, right? If you come down and start looking more, here's one. CMBS auction data, and I'm tired, could signal investor losses ahead. Now, that's an interesting thing. She's like, well, wait a minute. That was 3 weeks ago, and that's saying something that doesn't sound good. Like there's something over the horizon. But right here, if you read this one, the delinquency rates continue to improve. Now, everyone knows there was delinquency rates because when the economy shut down, a lot of CFOs realized one thing: as their employees were forced to go home and work remotely from home, they started to realize, hey, wait a minute, this is starting to work. And not only do I not need to pay space rent, water cooler fees and things like that. I don't even have to pay electricity costs. The employees are paying that. And under the new tax laws, they don't get even a tax write-off for that. It's actually really crappy. So let's go on a little bit farther, okay? We're going to first off go over what a CMBS is for those of you that don't understand. CMBS stands for a commercial mortgage-backed security, as these loans are later pooled with similar loans and packaged into bonds that can be sold to investors on the secondary market. CMBS loans are known for their lenient credit requirements. I want you to remember that. Very, very important, okay? When we're talking about CMBSs and their credit worthiness, that's one thing. The other part that's very important is loans are later pooled with similar loans, okay? Very similar. It's identical to what happened with mortgage-backed securities back in 2003 to 2006. And then again, they're sold to investors. Now, the investors that we're talking about are hedge funds, pension funds, things like that. And you're typically a fixed rate term of 5, 7, or 10 years. All right, now let's jump over here. CMBS loan amortization. Do you guys remember? I've talked about NAGAM loans and that they're coming back, and people are saying, yeah, that won't happen. That won't happen. And do I believe it's going to happen in the residential real estate market? I do. But check this out. The vast majority of CMBS loans are not fully amortizing. Instead, most CMBS loans are partially amortizing, while others have partial payment interest-only periods or are full-term interest-only loans. The fact that most CMBS financing is not fully amortizing means that borrowers typically face a large balloon payment at the end of their loan term. In most cases, they'll refinance the CMBS loans to avoid paying the balloon. All right, now this is where it gets really interesting, guys. We're going to stop sharing. I want to make this extremely clear. The CMBS mortgage market is incredibly massive. As a matter of fact, in the last 10 years after the Great Recession, a massive amount of commercial buildings have been built in our country because we have lived in the last 12 to 14 years. Well, actually, you know what? Even going back to right after the dot-com crash, an unbelievable time of prosperity due to Federal Reserve easy money printing, right? A dovish stance. Low interest rates have been king since 2001. And we only had a couple of little blurps where interest rates rose. As a matter of fact, leading up to the 2008 crisis, the reason why that crisis happened was because the Fed started raising rates in 2004, 2003, 2004, and mortgage, the Fed funds rate ran up into the 5-6% area. That was enough to take out the mortgage-backed security industry because people couldn't turn around and refinance at the same or a lower rate. So they couldn't make those payments, right? Then you had the negative amortization loans that were just running havoc, but those really still were not that big of a part of the market. Okay. Now you have commercial. Now I want people to understand literally how big this is. I hope you made it to the end because I want you to do me a favor right now. You're going to get the best part of the video. Hashtag CMBS, hashtag real estate in this video. So I know you made it to this part. Back in the housing crisis, when the mortgage-backed security market imploded, you didn't have a time where the government forced people to leave their homes and go live out in a park, and which pretty much made the house completely worthless, right? It's now sitting vacant. Well, that is exactly what happened in 2020 or 2020, 2021, when people were forced to leave their place of work and go work from home, isolated, now rendering that commercial building completely useless. And that is what is going on right now. Now, what I also want you to understand is that commercial mortgage-backed securities industry is so massive. It is now went through a time of complete shock. Now, the only reason why it's not collapsing right now is, first off, just like the mortgage-backed securities, it takes time. It takes time for companies to stop paying their bills. It takes time for that news to make it to Wall Street through company earnings, things like that. But you're already starting to see the dam break because you're seeing multiple companies like Blackstone recently just had to give away one of their flagship properties down lower Manhattan or downtown Manhattan because two of their major tenants had moved out, and they literally handed back that bank, Blackstone, handed back that property to their lender at a haircut of about 50%. That's right. I want you to understand that Blackstone borrowed money from another institution or bank to buy that property, and they lost it. All right. The reason why is because people are bailing on their rents. Now, with commercial mortgage-backed securities, it's set up in what's called tranches, and they're priced at different rates based on the creditworthiness of the borrower. A commercial-backed mortgage security that pays higher is usually paying higher because it is dealing with a lower creditworthiness, or the creditworthiness of that commercial mortgage-backed security is not high, so it has to pay a higher rate. Another thing that people don't understand is on commercial mortgage-backed securities, when you do not pay, if your building is 50% rented, you do not have to pay the entire payment. Just like I showed you earlier, these are not fully amortized loans. They are literally exactly NAGAM loans, the same loans that everybody was freaking out about during the 2008 crisis that they were blaming for this that crash back then. But now you have commercial buildings, massive buildings. We're talking huge money. The buildings behind us right now, right now in this picture, there are some that have CMBSs right downtown where Wall Street is. These buildings are in your pension funds. I want you to think about that. You're hearing this first because this, and I started talking about this a year ago, well, actually last June, a few months before you had ever heard about Evergrande. And back then in China, I was talking about by January, and I was wrong about this, by January, everybody was going to know what a CMBS was, because by that point, I thought that the Evergrande story would have leaked all over the world. Quite frankly, because the Federal Reserve is still in the backgrounds buying up bad assets, and they're telling you they want to unload them, and they really do, and they're little by little unloading, but it's not what you think, because the market can't handle all that crap, those crap, financial products. They are hiding it right now, but the problem is the dam is breaking. And I believe still within this year, 2022, we are going to see a collapse in this commercial mortgage-backed securities market. And that is going to lead to lots of pension funds having to take write-downs because these assets are going to be deemed worthless. All right. Again, I want to also remind you, interest rates have moved up massively. So anybody right now trying to refinance a CMBS is not going to be able to do it because they have two headwinds. First off, their building is not fully rented. And secondly, mortgage rates have literally doubled. The rates have doubled in the last 120, 180 days. So if you can only imagine now, what you are witnessing is akin to what happened in mid 2005 to 2006, when mortgage rates started to shoot up because the Fed started raising rates and people started getting worried and nervous about the markets and where they were going to go. So they're unwilling to loan money into the market for a long period of time, let's say 10 years, and the 10-year bonds started to rise. Guys, this is going to be an epic crash. And quite frankly, for someone like me, billionaires own commercial property. I will be buying a commercial property hand over fist, especially mixed use property, turning a lot of commercial properties into residential properties, quite frankly. So I hope you got something out of this. I think this is a really exciting time to be alive, because when you know something's going to crash, don't worry about the little minutia of the market swings or if the market jumps up another 20, 30%, because there's always a day of reckoning. And that day of reckoning, quite frankly, is now here. You're witnessing it in real time because you are seeing the mortgage rates spike. All right, guys, I thank you so much for watching. Thanks so much, Nick Johnson, for getting me up and encouraging me to go and do a video before I did my hair. All right, guys, that being said, the Economic Ninja is out.